Embracing the wisdom of the kicking bullish pattern involves recognizing it as a strong indicator of a potential bullish reversal in the market. This pattern is distinctly marked by a gap, signifying a vigorous shift in investor sentiment from bearish to bullish. Understanding this pattern begins with identifying the gap between two candlesticks. The first candlestick, typically bearish, is followed by a gap and then a bullish candlestick. This gap is crucial as it reflects a sudden and strong change in market dynamics, suggesting that buyers are now controlling the market price. To effectively utilize the kicking bullish pattern, investors should focus on several key aspects. Firstly, the presence of the gap itself is a clear signal of market momentum swinging in favor of the bulls. Secondly, the bigger the gap, the stronger the signal, as it shows a significant shift in buying pressure. Therefore, when this pattern emerges, it often advises caution for bears and may prompt bullish traders to consider entering the market, expecting upward price movement. Moreover, it is essential to look at the broader market context when interpreting the kicking bullish pattern. This involves considering other technical indicators and market conditions to validate the pattern's strength and reliability. By doing so, investors can make more informed decisions and potentially capitalize on the opportunities this pattern signifies. In conclusion, embracing the wisdom of the kicking bullish pattern means recognizing its potential as a harbinger of bullish reversals. By carefully analyzing the pattern and considering the market context, investors can enhance their strategic approach to trading, aiming for favorable outcomes in the volatile world of stock trading. The kicking bearish pattern is a significant indicator in technical analysis that signals a strong reversal in market trends. It is characterized by a sharp contrast between two candlesticks on a chart. The first candlestick, appearing at the end of an uptrend, is a large bullish candle, which is followed by a gap and then a large bearish candle. The gap between these two candles is crucial as it emphasizes the sudden shift in market sentiment from positive to negative. This pattern suggests that the bullish momentum has exhausted and a strong bearish trend is about to begin. Imagine observing a chart where the price has been climbing steadily, represented by a series of green candles. Suddenly, at the peak of this ascent, there appears a considerably large green candle, larger than its predecessors, indicating strong buying pressure. However, the following day opens with a gap down, and the market forms a large red candle, moving in the opposite direction. This drastic change from a large green candle directly to a large red candle, without any overlapping price ranges, visually captures the essence of the kicking bearish pattern. This pattern is particularly noteworthy for investors and traders as it suggests a powerful shift in market dynamics. When identified correctly, the kicking bearish pattern can serve as a useful tool for making informed decisions about entering or exiting positions, as it anticipates a significant downward movement in prices following its formation. Investors and traders look for this pattern to help them navigate the complexities of market trends and make strategic moves based on anticipated shifts in momentum. Identifying the kicking bearish pattern involves recognizing a specific formation in the candlestick charts used in technical analysis. This pattern is characterized by a sharp reversal signal in the market, suggesting a potential downward movement after a bullish trend. To spot this pattern, look for two main components. The first component is a white or green candlestick that closes higher than it opens, indicating a strong buying day. The next trading day should then open with a gap down, presenting a black or red candlestick that closes lower than it opens, which signals strong selling pressure. This abrupt change from buying to selling indicates a sudden shift in market sentiment from positive to negative, suggesting that it may be a good time for traders to consider strategies that profit from declines in the market. The gap between the two candlesticks is a key feature, emphasizing the intensity of the market's reversal. Understanding the kicking bearish pattern requires careful observation of chart patterns and the ability to interpret the implications of such drastic shifts in market behavior. The kicking bearish pattern is a strong signal in the world of trading, indicating a potential bearish reversal. It is similar to its bullish counterpart, but moves in the opposite direction. Let us break down this concept for better understanding. Imagine the stock market as a vast ocean. Traders and investors navigate these waters, looking for signs that guide their journey. The kicking bearish pattern is akin to a lighthouse, signaling that the market might be changing course from a bull to a bear market. It is identifiable by a specific arrangement in the candlestick chart, where a particular bearish candlestick follows a bullish one without overlap in their bodies, suggesting an abrupt shift in sentiment. Now, shifting our focus to deciphering market sentiment, this concept revolves around understanding the collective mood or attitude of investors towards the market. It is crucial because it helps predict the future movement of stock prices. Think of the market sentiment as the current of the ocean. Sometimes it's calm, suggesting a steady market, and other times it's turbulent, indicating volatility. By analyzing patterns like the kicking bearish and other indicators, traders can sense shifts in this current, allowing them to make more informed decisions. By understanding and recognizing such patterns, investors tread more confidently in the often unpredictable waters of the stock market. The kicking bearish is a pattern that serves as a strong signal for a bearish reversal, which means it indicates a potential shift from an uptrend in prices to a downtrend. This pattern appears on price charts and is considered the opposite of its bullish counterpart, hinting at upcoming downward momentum in the market. At the heart of the pattern, there is an emphasis on the nature of the pattern being a herald of reversal. Essentially, it signals that the prevailing upward trend in the market might soon change direction, moving towards a decline. Traders and investors pay close attention to such patterns as they can provide valuable insights into future market movements, allowing for the adjustment of strategies to either take advantage of or protect against potential decreases in value. Understanding the kicking bearish involves recognizing its unique characteristics on a price chart. Typically, it starts with a candlestick that indicates optimism or upward momentum, which is then immediately followed by a larger, downward trending candlestick that suggests a sudden and strong shift in sentiment among market participants. This sharp change is what signals the potential for a reversal from an uptrend to a downtrend. For those monitoring the markets, identifying a kicking bearish pattern provides an opportunity to reassess positions and prepare for the possibility of a downward movement in prices. Acting on this information can involve locking in profits from previous long positions or considering short positions to capitalize on the anticipated decline. In the context of financial markets, a pattern called kicking bearish signifies a strong bearish reversal. This pattern is essentially the inverse of its bullish counterpart, implying a shift in market sentiment from bullish to bearish. The confirming the turn phase is particularly crucial as it validates the reversal indicated by the kicking bearish pattern. To confirm the turn, investors look for additional signs such as increased trading volume or subsequent price action that align with the bearish forecast. For instance, if the pattern is followed by a day where prices continue to drop significantly on higher than average volume, it reinforces the validity of the initial bearish signal. This confirmation helps traders and investors to make more informed decisions about entering or exiting positions based on the anticipated downward movement of prices. Understanding and correctly interpreting these signals can be instrumental in the successful navigation of the financial markets. The kicking bearish pattern is regarded as a strong bearish reversal indicator, essentially serving as the mirror image of its bullish counterpart, but signaling a potential shift in the opposite direction. When evaluating the reliability of this signal, it is crucial to consider the context in which it appears. The pattern is characterized by a sudden shift in market sentiment, depicted through a significant gap between the opening price of the current session and the closing price of the previous one, but with the price moving in the opposite direction. For investors and traders, the appearance of a kicking bearish pattern signals a strong market move towards lower prices. Its reliability as an indicator is increased when it occurs after a prolonged uptrend or at the culmination of price consolidation, suggesting a sudden and strong shift in investor sentiment from bullish to bearish. It is important, however, to corroborate this signal with other indicators and market analysis to enhance prediction accuracy. Factors such as volume, the presence of other technical indicators, and prevailing market news should be considered to confirm the reversal. By understanding and applying these considerations, investors can use the kicking bearish pattern as a part of a comprehensive strategy to make informed decisions in the market. The concept of kicking bearish represents a strong bearish reversal pattern, acting in contrast to its bullish counterpart, but in the opposite direction. This pattern is of significant importance when synergized with the discipline of technical analysis. Technical analysis, in essence, examines historical market data, principally price and volume, to forecast future price movements. The kicking bearish pattern, characterized by its visual representation on market charts, signals a potential downturn in the market, alerting traders and investors to prepare for a likely decline in price. In the synergy with technical analysis, identifying a kicking bearish pattern involves recognizing a sharp directional change, where a security's price opens significantly lower than the previous session's close with a gap in price action. This is often visualized on candlestick charts, where a long bearish, usually black or red candlestick follows a long bullish, white or green candlestick, without overlap between the closing and opening prices. The creation of such a gap is a classic marker of strong market sentiment, signaling a reversal. Technical analysts pay close attention to such patterns as they provide actionable signals that can inform trading strategies. The recognition of a kicking bearish pattern can prompt technical analysts to consider selling positions before anticipated drops in price, thereby protecting investments from potential losses. Moreover, in a broader sense, identifying this pattern contributes to the overall analysis of market trends, offering insights into market psychology and potential shifts in supply and demand dynamics. Understanding and identifying patterns like kicking bearish within the framework of technical analysis requires not only a grasp of the concepts, but also experience in observing market behavior. This marriage of knowledge and experience allows investors to navigate complex market conditions with more confidence, potentially leading to more informed and ultimately more successful investment decisions. Kicking bearish is identified as a strong bearish reversal pattern that mirrors its bullish counterpart, but it moves in the opposite direction. This pattern is crucial for traders and analysts because it signals a potential shift in market sentiment from bullish to bearish, representing a change in the price direction downward. When navigating through the pitfalls associated with this pattern, it is essential to understand that while it can be a strong indicator of future market movement, it is not foolproof. Traders should look for confirmation through additional indicators and market analysis to increase the reliability of the signal it provides. This might include examining volume trends, other chart patterns, and market news that could impact the asset's price. By taking a comprehensive approach to analysis, traders can enhance their ability to make informed decisions and potentially mitigate the risks associated with acting on false or premature signals. In essence, while the kicking bearish pattern is a powerful tool in technical analysis for spotting potential market downturns, it should be used as part of a broader strategy that incorporates multiple data points and analysis methods. This approach helps in navigating the complex and often unpredictable financial markets with greater confidence and precision. The kicking bearish pattern represents a crucial concept in technical analysis, indicating a potential shift in market sentiment from bullish to bearish, or in simpler terms, from a market that is generally moving up to one that is expected to move down. This pattern emerges in price charts as a stark contrast between two candlesticks. The first is a white or green candle, signifying buying interest, and it is followed by a black or red candle, which reflects a sudden increase in selling pressure. The key characteristic of this pattern is the gap between these two candles, with the selling pressure candle opening lower than the buying pressure candle closed, thus indicating a dramatic change in investor sentiment. In strategic applications, recognizing a kicking bearish pattern can signal traders to consider adjusting their portfolio, potentially shifting from holding long positions where they benefit from rising prices to adopting strategies that benefit from a decline in stock prices. For instance, an investor might decide to sell certain holdings to avoid potential losses or to engage in short selling, where they can profit from declining prices. However, it's important for investors to consider other market indicators and analysis to support their decisions, as relying solely on a single pattern could lead to misinterpretation of market trends. The strategic value of detecting a kicking bearish pattern lies in its ability to serve as an early warning system for a potential downturn in a previously bullish market. By acting on this information, investors can proactively manage their risk and reposition their portfolio in anticipation of a different market environment. However, as with all strategies based on technical analysis, it is advisable to seek confirmation from additional indicators or patterns to reduce the risk of false signals. The kicking bearish pattern is a strong bearish reversal indication that is seen in the stock market. This pattern appears on a chart following a period where buying might have been dominant, suggesting that a bearish trend could be starting. It is characterized by a sudden shift in market sentiment from bullish to bearish, often highlighted by a gap between two candlesticks. The first candlestick is usually green, indicating buying pressure, followed by a large red candlestick that opens below the previous green candlestick, showing a sharp turn to selling pressure. Exploring variations of the kicking bearish pattern involves recognizing slight deviations from this classic setup that still signal a potential bearish reversal. These variations might include differences in the size of the gap between the two candlesticks or variations in the volume of trading activity accompanying the pattern. Understanding these variations can help investors to identify potential bearish reversals more accurately and to make informed decisions about their investment strategies. Such knowledge allows investors to manage risks better by anticipating market downturns before they occur fully.